Stop what you're doing and look at your car. It might be the single biggest trap in your financial life. We are watching a silent financial apocalypse unfold, and the canary in the coal mine isn't the housing market or credit card debt. It's the humble auto loan. A new report from VantageScore has exploded onto the scene, revealing a terrifying shift. Delinquency rates have surged by over 50% since 2010. This is not normal. It has officially transformed the auto loan from one of the safest consumer products into the riskiest, most toxic debt in America. This crisis is a deep wound in the consumer economy, and it's a direct result of forces you were never meant to fight alone. The real question isn't if the dam will break, but who engineered this massive $1.7 trillion debt cage in the first place, and why you're stuck inside it. The first unavoidable pressure point is the price. The sticker shock is no longer just a shock, it's a financial wall. The average new vehicle transaction price has blasted past $50,000, pushed higher by luxury models and expensive EVs. As a direct consequence, the average monthly payment for a new car has now soared above $750. Think about that. Almost $1,000 every single month before you even pay for gas, groceries, or rent. This unprecedented cost escalation, combined with relentless interest rate increases and skyrocketing insurance, has created an affordability crisis unlike any we've seen in a generation. According to one study, paying off a new car now requires an average of 42 weeks of income, up from just 33 weeks before the pandemic. Buyers are being priced out of reality, but the industry found a dark solution to keep the sales machine churning. The industry's solution? The 84-month loan. That's 7 full years, a term unheard of for a depreciating asset. This long-term debt is the engine of the crisis. It lowers the monthly payment just enough to convince stressed consumers they can afford the $50,000 car, but it does so by forcing them into a financial torture chamber. For a typical $40,000 loan, extending the term from 5 years to 7 years can mean paying thousands of dollars extra in interest alone, all going straight to the financial institutions. But the most dangerous side effect is the negative equity trap. Because a car loses up to 20% of its value the second you drive it off the lot, the long term ensures you remain underwater, owing more than the car is worth for most of the loan's life. If you need to sell or trade in early, you have to write a massive check just to break even. This leads us to the most devastating record just set in the last quarter. The data on negative equity is a wake-up call that should terrify every consumer. Edmunds reports that a record high of 28.1% of all trade-ins for new cars in the third quarter of 2025 were underwater. That means more than 1 in 4 drivers are rolling debt into their new purchase. The average amount of this rolled over negative equity hit a record $6,905. But here's the most mind-blowing detail. Almost 1 in 4 of these upside-down trade-ins, that's 24.7%, were carrying more than $10,000 in debt from their previous car. Consumers are literally paying for 2 cars at once, driving their average new monthly payment to over $900. Analysts say this is driven by buyers trading in vehicles too quickly, often a mere 3.7 years into a 7-year loan. They're addicted to the new car smell, and the debt is accumulating into a catastrophic national pile. This brings us to the shocking failures in the financial system that allowed this ticking time bomb to be built. How did lenders get away with this? They took a massive gamble. During the years of pandemic stimulus, many consumers' credit profiles looked artificially robust. Auto lenders, especially those operating in the subprime space, loosened the standards. They gave out longer-term, high-interest loans on overvalued vehicles. It was a gold rush based on a temporary illusion of financial health. Now, as those stimulus checks are gone, as student loan payments have resumed for millions, the scoreboard is catching up with reality. The system is showing signs of deep infection. When major subprime auto lender Tricolor filed for bankruptcy protection recently, Wall Street's most powerful voice let loose a terrifying warning that has shaken the entire financial sector. 6. Jamie Dimon's cockroach warning, the systemic infection. JP Morgan Chase CEO Jamie Dimon is not prone to exaggeration, which is why his statement in October 2025 sent a shockwave through the markets. When you see one cockroach, there's probably more. He was referring to the collapse of Tricolor, an auto-related company, and the subsequent $170 million charge taken by his own bank. Dimon's message was chillingly clear. The auto loan distress is not an isolated event. It is a bellwether, a sign of deeper, hidden credit problems rippling through the wider economy. The failure of one subprime lender suggests lending standards everywhere had become too lax. This is the financial industry's deep, dark fear, that the personal debt crisis is now metastasizing into a systemic threat. The final, most betraying detail? The identity of the fastest-growing group of victims. You might assume the crisis is only hitting the riskiest, lowest credit borrowers. You would be dead wrong. The VantageScore data unearthed a staggering fact. The biggest year-over-year increase in late-stage delinquencies came from the superprime and prime segments, people with good or excellent credit. The mid-tier borrower is cracking under pressure. Why? Because while they had strong credit, they are being financially annihilated by the crushing combination of inflation, stagnant real wages, the return of student loan payments, and those absurdly high monthly car bills. The pressure on the middle class is so intense that even good credit no longer offers protection from the 8-year debt cage. They are the final, most alarming indicator that the crisis has gone mainstream. America is now grappling with a $1.7 trillion consumer car debt that is defaulting at a rate parallel to the years leading into the 2008 financial meltdown. Auto loan delinquency is not just a personal failure. It is the harsh evidence that the price of essential transportation has been deliberately inflated beyond the means of the working population, forcing them into financial servitude. The average American is trapped, locked into a high-interest, long-term loan that keeps them perpetually underwater and at the mercy of the next economic downturn. The question for every viewer is, are you driving a car, or are you driving a liability that could sink your entire financial future? The financial institutions have sounded the alarm, but only the consumer can choose to break the cycle before the whole system comes crashing down.